Hello, everyone. Today on the Final Bar, my guest is Gary Dean from sentimenttiming.com. We'll talk about his view on the overall market conditions. The S&P, I would say, continuing to chop around today. The adjective is choppy, with the S&P essentially finishing flat, the Dow higher, the Nasdaq lower. Plenty of news flow happening, as well as Coinbase's earnings report here after the close. Energy and the cyclicals really leading to the upside. We're also going to answer your questions from the Final Bar mailbag. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the activity in the markets, using the power of StockCharts, using data visualization methods to understand, to quantify investor behavior, investor psychology, investor decision-making, lean into what's working, lean away from what's not working. We've talked often about the momentum-based process, the trend-following toolkit of identifying trends, following trends, and anticipating when those trends are exhausted. And when I look at the chart of the S&P, even though you get a doji candle of sorts, like today may actually qualify as, we'll have to look at the daily chart here in a moment. Overall, the trend certainly appears to remain positive. Now, where you've certainly seen a lot of rotation is in leadership, right? Today, for example, you have energy, materials, financials, industrials, those four cyclical sectors back up to the top. Big infrastructure bill, obviously, today was part of the news flow. On the downside, you have real estate and technology. So we're going to talk about this value versus growth sort of thing. We'll talk about the financial stocks, talk about stocks like Nucor, NUE, breaking to new all-time highs, and what all of those mean in aggregate in terms of the trends to pay attention to. I'm excited to talk to our guest, Gary Dean, today from sentimenttiming.com. Tomorrow, on Wednesday, the 11th, we have Samantha Leduc from Leduc Trading. On Thursday, the 12th, Matt Tuttle, founder of Tuttle Capital Management and manager of ETFs like the SPCX, an actively managed SPAC ETF, as well as the FOMO ETF. Coming up next week on Tuesday, the 17th, Sean McLaughlin from All Star Charts. And on Wednesday, Jay Soloff from Investors Alley joining the show once again. Also, just to let you know, my next webcast as part of my market misbehavior platform will be 1 week from today on Tuesday, the 17th. We'll be talking about relative strength. Walter Deemer, who was the technical analyst at Putnam in the 1970s, once quoted me in his book as saying, "I never look at a chart without relative strength," and he's not far off. You probably know from watching this show that I use relative strength on most of the charts in terms of understanding the relative performance of one stock to many others. It's a free event. We'll talk about relative strength, some of the different ways to visualize it, and focus on the stocks that are leading today and demonstrating their ability to outperform. Go to marketmisbehavior.com/relative strength to sign up for that free event if you're interested. Let's continue on to today's market recap. We're going to start with a poll. We always have a poll going on our Stock Charts live stream page, Stock Charts TV live stream, that is, on StockCharts.com, also on social media. And recently we asked you, would Charles Dow, father of technical analysis, consider an uptrend? And I'm thrilled when 94% of you answer correctly, higher highs and higher lows. You may ask, why am I asking such a simple question in the poll for the 94% of you that got it right? And I would argue that it is never too many times to reinforce that basic concept. A lot of times when I found investors and traders getting off script, starting to have some troubles, a lot of times it goes down to routine, your decision-making process. And for me, the very foundation of any analysis of any chart starts with the basic analysis of trend. Is this chart going higher or lower? And Charles Dow created a very simple methodology to help you quantify that. I would encourage you to start there, and all the other stuff, the indicators, the trend lines, the moving averages, the Fibonacci retracements, the MACD, whatever else it is, should come over after that. Very basic, a very foundational answer. So well done, Final Bar Nation, correctly answering higher highs and higher lows. Continuing on with today's market recap, the S&P really, I think, continues to be in digestion mode. After the run higher, let's go right to the chart of the S&P. We've had this run higher, and the trend line that we'd used from October to March played really well with the market in May and June, and then all of a sudden it started to become less and less representational of the overall trend. The trend's changed a bit, right? And you can see the change in trajectory from this uptrend that was November through May to June. And the change we've had, we started to break down through this trend line support and sort of now rotate around that trend line. For me, I've sort of leaned more on the 50-day moving average, which has certainly indicated the appropriate pullback amount pretty much the entire year. We've had a number of pullbacks to the 50-day that is consistently held. It's currently around 43.15 to 43.20, which would mean if and when we would get a pullback, as many have expected, and I'm certainly in that camp, being in the seasonally weakest part of the year, given the deterioration we've seen in breadth and momentum, don't think that's unreasonable to see a pullback to the 50-day moving average. It's about 4% below current levels. As I mentioned, around 43.15, 43.20. A day like today, which is basically a doji candle, it might be hard to see on the 2-year chart or the 1-year chart, but that's kind of what it looks like when the open and close are right about at the same level. But overall, again, we keep making higher highs, which is what we've done today. As we just mentioned in the poll, higher highs and higher lows are an uptrend. That is what the S&P continues to put in. However, days like today really not directional, right? We've had a couple of days like this in the last week where it's been more choppy, and we're back to that scenario that we've seen, haven't seen as much recently, but had certainly seen for quite a while, where the Dow would be up, the Nasdaq would be down, or vice versa, and then the S&P kind of flat in the middle, and sort of shows that rotation that we've been in for a while now. The mid cap and small cap index outperforming the large cap index, with the small caps doing the best, up almost 1%. Now there's an overweight in financials, things like financials and others in the small cap index that are underweighted, relatively speaking, in the large cap index, and that's why you're probably seeing that do well today. The Nasdaq not doing well, down about 0.5% for the Nasdaq 100, then the Nasdaq Composite. Other asset classes, very quickly, interest rates continue to rise, and you've seen this rotation lower on the TLT and the ag and other bond price indexes, or ETFs rather, and you've seen on the yield chart, the yields go higher, and I have no doubt over the long term that interest rates are going to go higher than they are now, because that is the general concept of, I think, what the Fed is going to be attempting to do. That's what their actions will most likely, how they will impact. They're going from a colossal all-time low, chronic down, minimal interest rates, and all of a sudden starting to ratchet those higher as they back off their bond buying programs. And we're just hearing, talking about when that might play out. I heard something today about in September next month, we start to get some details of how the Fed may be changing that policy and how they might implement that going into next year. And so far, what we've seen are rates going higher. Now, the general idea of rates going higher in general would be more of a tailwind for things like financials and cyclicals, more of a headwind for things, growth areas like technology and consumer. However, you have to remember that those are not happening in a vacuum. There are a lot of different moving parts going on at any point. Dollar index essentially flat. We're going to look at the dollar index in a little more detail toward the end of the show, and focus on that overall rotation higher and how we might be setting up for the next move higher there. Commodities overall positive, although gold flat and silver down. So it wasn't in the precious metals, it was in the other parts of things. And as I mentioned, energy number one, oil prices appreciating just fine. Cryptocurrencies coming off of a fairly significant run this weekend into through yesterday, really, where Bitcoin was above 46,000, now back down around 45.5, but overall, again, fairly elevated relative to the range that it had been in, between about 30 and 42,000 for quite a while. We only have a couple minutes left, so I just wanted to hit on a number of different charts. And we talked about Nucor Energy, or Nucor Corp, just a little bit ago in the materials sector. This is a stock that had been one of the top ranked scooter stocks. It still is now. So it's actually in the top 10 of the scooter universe, top percentile, really, in the 99th percentile. And days like today certainly are what help keep it up in that section, because you've now made a new 52-week high yet again, getting above the June high. Now, energy and materials and others had pulled back, certainly May, June into July, financials as well, industrials as well. But you've seen an appreciation on some of the material stocks and other parts of the cyclical sort of group as well. But you're seeing now a break to the upside. And this is up about 9.5%. And I would imagine this is all related to the infrastructure bill going through. And again, the implications of that, how do you balance the infrastructure spending with potential, economic implications of the coronavirus and whether or not we have to start, ratcheting things down again if and when that would happen. I mean, there are a lot of unknowns certainly continue to be, but a day like today with that happening on the chart certainly indicates a vote of confidence in stocks like this and their ability to benefit from broad spending and on infrastructure. So infrastructure plays certainly doing just fine today. NUE came at the top of my list, being one of the top performers in the large cap universe, and also one of the stocks that we reviewed earlier when it was one of the top ranked stocks, sort of in the first to early second quarter as well. Another one I just wanted to bring up was Coinbase. So Coinbase is a really interesting chart. We'll look for a second in a moment here about how it's trading in the aftermarket, because again, they're having their earnings report today. IPO date was in early April, so we're now a couple months into the experience. And overall, Coinbase has been a fairly disappointing IPO, coming off of jumping off pretty quickly off of the IPO, but then quickly coming below it, hitting support around 210, 215 a number of times. But then in the last month, putting in some higher lows, and in the last week, really rotating higher as cryptocurrency prices appreciated it. Today, you have what's not quite the bearish engulfing pattern, but a bit of a negative. I actually think you'd call this a dark cloud cover, if I remember my candle patterns correctly. That's digging into the details a little bit. But overall, coming off after yesterday's significant run, I wanted to look very quickly here to wrap up our market recap, see what's trading. So not much of a change actually in the aftermarket. It was down almost 4% today and coming up a little bit, up 0.2%, but really nothing significant just yet. We'll have to see how that plays out. Obviously, plenty of distribution before the end of the day today, so maybe a muted reaction after the close. Let's take a quick break. We'll be back with my guest, Gary Dean. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close for our show. We're going to get to our guest, Gary Dean from SentimentTiming.com momentarily. Before we get there, I just want to do a couple quick announcements. Number one, remember, we have our mailbag segment a little later in today's show. We'll do another Final Bar mailbag at the end of the week on Friday's show, and we would love to answer one of your questions on the air. Anything is fair game. Questions about technical analysis, particular indicators, particular charts that you're struggling to understand, or anything about market history, investor sentiment, whatever it is, we'll do our best to point you in the right direction. Get your questions to us one of three ways: via email, thefinalbar@stockcharts.com, via Twitter @FinalBarSCTV, via YouTube. Just put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions and hope to answer your question on our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. Use your email address. You can set up a free account, start watching all of our wonderful content right from all your mobile devices, from your computer as well. Great guests like Gary Dean and many others. Special events like Charting the Second Half and The Pitch, and great shows like The Final Bar and a great many others from fantastic team of hosts. Go to StockChartsTV.com or just search on any of the app stores for StockCharts TV on demand. I want to welcome on today's show, joining us once again, Gary Dean. Gary's the co-founder of SentimentTiming.com, does a great job of taking the macro environment, putting it into proper perspective. Gary, welcome back to the show.
Dave, thank you for having me back again. I enjoy doing this every time with you. Always, we were talking about it before, where it seems like the market's in the same situation each time we were doing the show together, and I feel like I'm showing the same charts. But one of the things that I really follow, especially through the StockCharts.com, is I really look at the internals through there, because I think it gives you a really good perspective as far as are we in you were talking earlier about an uptrend and a downtrend, and we're in an uptrend right now. But what we try to do at Sentiment Timing is give how safe is this uptrend? Is there what are the odds of it making a turn? What is going to be the confirmation of the turn? And one of the charts that I really enjoy looking at is the value line. It's it gives you a divergence, and it doesn't happen often, as you can see on the the chart there. I have the last few times that we've had these divergences, so they don't come into play a lot, and they're not. It's not something where the market has to turn right now. What we look at is, do we look at them as red flags? So it's one that's there where yes, we are in an uptrend. We're not. There's no way to poke any holes in that, but this is giving us a little bit of a red flag warning sign. Now, the chart next to that is the NIAD, and it's another one that I really like to look at, because we really don't have any real big reversals that stick without some type of advanced decline divergence. And we have one in play right now. Again, it's either going to fix itself and we're going to get another leg higher, but right now it hasn't fixed itself, and it's another red flag where it doesn't mean the market has to turn right now, but it's telling you that it could turn at any time, and it would make perfect sense because these internals are not following the price action of the S&P. Especially, we really haven't done anything for the last 2 weeks. We've gone nowhere. It's, like you said before, a little bit of a chop session. So these two charts are kind of what we look at with the, is what's the environment like? Is it safe? We're in an uptrend. We're making higher highs. There's no divergences in the internals. And then from there, we just really look for price and wave structure, which you can see on the next set of charts that I sent over to you.
Perfect. So we got those divergences on the first two charts, and I totally hear what you're saying, Gary. We've had these higher highs in price, but a lot of the broad indicators, then looking at the median stock and then the breadth, starting to diverge. Second charts here are looking more at the momentum behind the wave structure behind the S&P. What is this telling you?
So what this is telling me is I'm not like a big wave structure following things from the very beginning. I really focus in on Elliott Wave, and we're starting to see the red flags and the internals that are there, because it lets me know where things are. So in the bigger picture, the red 1, 2, 3, 4, 5, that's your bigger, say, wave structure right there. So now the little blue ones is telling us that the way that the Elliott wave really works is it's going you're counting to 5, and so once this wave 5 of 5 completes, we should get a pretty healthy pullback. And I know you had mentioned earlier about testing the 50-day moving average, and obviously that's going to be what, if the bears are going to get any kind of panic selling to hit, they got to get it through the 50-day moving average, because we've seen nothing but buy programs hit every time we're there. But one of the dangers that I'm seeing right now is price is not really accelerating from the 50-day over the past couple weeks, and that's moving up. So one little kind of hard move down could take us right to that 50-day. And my real target when the pullback comes again, and it's above my pay grade to say exactly when that's going to hit, especially in this market. But it's really, we're looking for a test of the 200-day moving average. So we're looking anywhere down near the, say I think it's 39.66. I really can't see right there the whole thing, but somewhere in that range there would make sense. And it's not saying that we're going into a bear market or anything. It just would be a healthy little pullback. Let the market digest this move that it's made from the March 2020 lows, and give some people a chance to get in. So that's really, and we may have this chop going, into, September, maybe even October. It's going to be tough to say, but our ultimate, what we're looking at, what we've been telling our clients is, right now you can stay long. We're making the higher highs, but there's red flags everywhere on here. So be very cautious. If anything, we're not even against taking off longs and just kind of waiting for the pullback. But our ultimate buy zone is going to be near the 200-day moving average, and we want to see how the bulls react there, which we believe they will act pretty good. But the way that the wave structure is with the larger, 1, 2, 3, 4, 5, that's actually looking for a move that can go down to the 3600 level and make perfect sense as far as with the Elliott Wave structure. But we're just really trying to take things a view of 1 to 2 months out, and that's something that could be much longer out on that end of it. So right now we're looking for obviously the test and break of the 50-day moving average, but our ultimate target is going to be a test of the 200-day moving average sometime in the fall, if not a little bit earlier than that. So
Gary, we have to wrap up and move on. Listen, this is fantastic. I really appreciate you sharing your overall take on things and giving us a sense of the potential downside. And I appreciate you sharing a downside target to the 200-day. Listen, be well, stay safe, Gary. We'll talk to you again soon.
You got it. Thank you.
That's Gary Dean. Gary's from sentimenttiming.com. And I think he hit on a number of the things that we have. But what I appreciate about Gary's comments, he incorporated some of the Elliott Wave structure. And as you probably know from watching the show, if you have, this is not an area that I get into. I'm familiar with Elliott Wave, and I very much appreciate people sharing that. What he was describing, if you're not familiar with it, is basically we're in a wave 5 of 5, which is when you have this 5-bar pattern going up, or 5-wave pattern. We're at the end of that. It's a 5-wave uptrend, and then the 5th wave is also comprised of 5 waves as well, which overall is essentially setting up for a big reversal and downside targets at the 200-day moving average. Great to hear from Gary Dean from sentimenttiming.com. Want to continue on with our next segment, the final bar mailbag. As I mentioned earlier, we love to hear from you, particularly questions that are coming up as you are analyzing your own charts. And we love to be able to point you in the right direction with your investment process. Our email, by the way, is thefinalbar@stockcharts.com. We're here for you anytime, and let us know what is coming up in your own process. Let's get to the questions. Question number 1 that's coming from you in the last couple of days. When you discuss the PPO that shows medium-term bearishness, what is the period for medium-term bearishness? And I think the chart you're referring to is this one. This is a question we had after our Friday show. We're reviewing the weekly the market trend model after the close on Friday. This is the chart we're looking at, and as you probably know if you've seen the show on Fridays, we go through these the Mindful Investor Live chart list. Is the first chart we look at every time, and I review this with clients very regularly as well. The idea is you have a long-term, medium-term, and short-term component. Now, for me, those words, those labels are relatively subjective. There's not a hard and fast time frame to those, because I found the trend, at times doesn't really care what your time frame is. It'll change depending on what it does. So the long-term model is really meant to capture the structural trends. It'll only give a couple signals in a 5-year period, as you can see from what's happened here. The medium-term model is meant to give you maybe, on average, I would say it's probably looking at the next 1 to 3 months. But that's a total guess. Looking back at history, that's probably about a pretty good gauge of what it's been signaling. And then the short-term model is really only telling about the next the next week or two. Is really just representing what the most recent move has been. On last Friday, did we close above or below the 50-day moving average? So the medium-term model being negative tells me the next 1 to 3 months to be thinking more on the downside. And again, I tend to think of short-term as a couple days to a couple weeks, medium-term as a couple months to a couple years, long-term as more than that. And that's kind of how I designed this model to be in line with that very general timing structure. Question number 2, can you let me know how I could add the new high, new low data for the Nasdaq to your chart below? As you can see, my attempt failed. I love your honesty. This is the chart you sent. Let's take a look. So you have the S&P here. We have new highs and new lows on the New York Stock Exchange, common stock only. We have the S&P 500. Then we have no data. So let's check what we're doing down here. And yeah, you've made up a ticker or two. So let's fix that. I think I'm going to guess that I think it's N and new low NAS and not NAHL. And I think that should work. There we go. Success. So you just had the wrong tickers. It's exclamation point new high NAS, exclamation point new low NAS. So you had the chart constructed correctly. It was just the tickers were wrong. So having said that, what do you do to find the tickers? If you go up here and type something like NASDAQ new high, it should. Now, again, the problem is we have a lot of different data on here, but you see the third one is one of the indexes we use, NASDAQ new highs. I would check the listings of these. If you go to the information page on each one of these tickers, you can get a little more data on it. Having said that, the way that I learned all of these charts and all these tickers was if I saw one, I would ask the person who wrote the article, hey, can you send me that chart? And I will tell you just from my experience of, for me and people like Julius DeKempener and others, we're pretty willing to share with you the charts that we're using. So if there's something that you see, just shoot me an email, thefinalbar@stockcharts.com. Let me know what chart I'm showing that you want. I can send you the chart as a link, and then you can open it and you can use that. And that's how I learned. It was guys like Tom Bowley and Arthur Hill and Greg Schnell and many others. And I basically took their charts and learned how they did it. On my list as chief market strategist is to have a better homepage for breadth on stock charts, and boy, I will get to that at some point. Next question: the RRG weekly and daily are depicting different sectors in the first quadrant. So what to believe? I love that question so much. Here is the weekly RRG. You can see here. Let's see, technology, healthcare, probably the most improving. Real estate, the strongest, being on the farthest to the right. All the cyclicals heading southwest, the direction of deterioration. Let's keep that imprinted in our brain. We could probably show both of these together, but I don't have time for that, given the limited time. Now on the daily RRG, bit of a different picture, right? So you have financials, probably the most improving, along with materials, heading northeast into the leading quadrant. Energy is actually starting to improve, coming from the lower left to the upper left, and heading in the right direction. So what to believe? So I think you believe all of them, but it depends on your time frame, right? So the daily RRG is going to give you the short-term rotation when short-term things are coming in and out of favor. So the fact that financials are bouncing to new highs, stocks like Nucor are going to new highs. That's why the XLF and the XLB are improving on that short-term time frame. But the fact that they're still so beaten down on the weekly RRG, in my opinion, what that tells you is that there's a lot more to prove. They've just started to bounce up. They've just started to improve on a relative basis. And so as a result, they really haven't proven their ability to outperform. The RRG is really a historical reference about what sectors have done well and what sectors have not done well on a relative basis. So the daily one can be an interesting one for rotation, for mean reversion. And in general, I've seen that be the better use of the daily RRG, is just understanding short-term rotations as things pop higher and pop lower. But for me, and thinking of the long-term time frame, the weekly RRG is the main one that we look at on this show, and the main one that I would pay attention to for that reason. Well, we need to wrap the show. It goes so quickly. 3 charts in 3 minutes, the 3 and 3. Let's get to it. Chart number 1 is the US dollar index. We didn't talk a ton about this earlier, just for time reasons, but I wanted to just illustrate this. When we reviewed the dollar index, for the last month and a half or so, it's been kind of choppy sideways, right? The UUP has hovered around that 24 to 25 level. The dollar index that we have here has kind of fluctuated from around, we'll call it 91, 91.50 up to around 93. Continues to be range bound, but it's just starting to potentially show signs of a breakout. And I'm highlighting what you may consider sort of a cup and handle pattern, sort of this rounded bottoming pattern. A shallower pullback puts in a higher low. We're above the 50-day moving average. We break that neckline. I think that could be a pretty encouraging signal that you start to see the dollar really exert itself further versus other currencies. So what does that mean? Well, if you look year to date, because the dollar index is much higher than it was at the end of December, you can see that the US has essentially outperformed most non-US ETFs, if not almost all of them. I was speaking actually to a group of technical analysts in New Zealand yesterday, and we were talking about just the strength of the U.S. market versus non-U.S. markets in general, and this dollar index doing what it's done, reversing from a downtrend in 2020 to an uptrend so far in 2021 is the story. I think that breaks out, and you want to continue to lean to the U.S. and away from non-U.S. Chart number 2 is looking at Amgen, always keen on finding candle patterns of interest. This is what you might call, there are a couple things you'd call. It's probably just call it a hammer candle. So a hammer is basically where the open and close are really close to themselves up at the top of the range. Very little to no upper shadow and a long lower shadow, which means we opened at a certain point, traded much lower, but by the close, we got right back up to the highs of the day. You can see a similar pattern back here at the end of April before we sort of bounced higher. So this is a stock that's been beaten down. It's been in a group, biotechnology, that hasn't been that bad. It's actually been a pretty decent group overall, but Amgen's been lagging behind the group and underperforming the market as a whole. I'd be looking to see if that is a short-term buy signal, as it usually is for candle chart users, as an indication of short-term demand. Finally, this is your friendly reminder that at all times in all markets, there are stocks making new all-time highs and new all-time lows, or at the very least, new 52-week highs and 52-week lows. Nucor and some of the other infrastructure plays certainly doing well. So if you've been avoiding those, I think the move today may indicate a necessity for you to consider it in your process. Folks, that's our show for today. Special thank you to Gary Dean from markettiming.com joining us on the show today and sharing his point of view. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe, be well. We'll see you next time. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.